A very good morning to all of you students. Today we will be continuing on the topic of mergers and acquisitions. So let's start with the question number 9 students today, because in the previous session we have covered till question number 8. I hope all of you would have revised the concepts so that we can build upon on those things in the today's session. So question number 9 students, it says that MPLC and CPLC operating in same industry are not experiencing any rapid growth, but providing a steady stream of earnings. MPLC's management is interested in the acquisition of CPLC due to its excess plant capacity. Share of CPLC is trading in the market at £4 each. So this is the current price at which the shares are trading. Other data related to CPLC is as follows. This is data actually. Profits after tax is given for MPLC, CPLC, and even the combined entity they have given to you. Residual net cash flow per year also has been given to you. Required return on equity, okay, that is also given. Balance sheet in the form of the different assets and the different liabilities is also given. You're required to compute minimum price per share CPLC should accept from MPLC. And then let's read out the other requirements also. Maximum price per share MPLC shall be willing to offer to CPLC. So they are asking to calculate the deal price from both the point of views. From CPLC's point of view, because CPLC will expect something bare minimum. Similarly, MPLC will expect something maximum payable, right? Beyond that, MPLC will not be able to pay. Similarly, from C's point of view, CPLC will need something minimum to be received. Below that, CPLC will not enter into a deal. Floor value of per share of CPLC, whether it shall play any role in decision for its acquisition by MPLC students. Good morning, Shailesh, Mansha, Shruti, Viraj, Kumar Jyoti. Okay, Kumar Jyoti, we will again check the calculation. Okay. So students, now if you see, first of all, from the valuation perspective, what all information is given to you? You have been given the residual cash flows and you have been given the cost of equity, right? So using this, can you compute the value of C and M respectively? Yes. So let's start. First of all, value of CPLC will be given by residual cash flows divided by KE minus growth, right? If we have to calculate the value of any company, right, we use this formula, which is the dividend growth model, right? So for CPLC, what was the residual cash flows? 40 lakhs. Is there any growth that is given? No, there is no growth. However, the cost of equity is 11.25%. Correct? So 11.25% is the cost of equity. Growth is 0. So this gives us value of 0.35 555 556. So 35 million 555,055.6, right? This is the value that is coming. Then MPS or value per share of CPLC is equal to, we will just simply divide this with the number of shares. Correct? Number of shares are how much? 5 million common shares, students. So 5 million we will take. Good morning, Anusha. Okay. So value per share comes out to be 7.11. Correct. Similar calculation we have to do for MPLC also, right? Because for MPLC also, we need to know that what is the overall value coming out to be, right? Before that, let's also compute the book value of CPLC because we have been given the balance sheet, right? Using that, we can calculate the book value, right? So the net worth is this much 2475 plus 5 million, right? So 29.75 million becomes the book value. 29 million 750,000 divided by again 5 million. Okay, so this gives us bond of 5.95. Okay, this is the book value. Now let's calculate similarly the value of MPLC. Again, we will use the same formula. Residual cash flow was how much? 66 million divided by 12.5%. Minus 0. The growth is 0, right? So this becomes 48 million, students. Correct. So the value of MPLC becomes 48 million. Similarly, the value of combined entity, because the similar data is also given to us for the combined entity. So the cash flows are 12 million divided by 12%. That means 100 million. Correct. So can we calculate what is the synergy first of all, students? See, if you if you see these numbers, so 6 million plus 4 million becomes 10 million. But here the combined entity is having 12 million. So that means there is some synergy value, right? How can we find synergy value, students? Very easy. Value of synergy is equal to combined value minus value of CPLC plus value of MPLC. Correct, students? Individual values of CPLC and MPLC, if we reduce from the combined value, we will get the synergy. 100 million minus individual values are 48 million and 35.55 million. Plus 35 triple 556, which is equal to 16 16.444444 million. Okay. Now, students, with all this data, now think it from CPLC's point of view, right? Because the first part is to tell about the valuation from CPLC's point of view. So what do you think? The current market price is at 4 pound, right? The book value is at 5.95. And the MPS, or let's say the revised value per share basis the cost of equity is coming out to be 7.11. So the minimum price that CPLC should accept is actually 5.95. They should actually protect their interests of the book value, right? Although in market it is going a lesser amount. the share price is going on a lesser amount, but it might be due to some other reasons, right? Because we have just now calculated the correct market price should be 7.11. So if not 7.11, the company should at least get 5.95, right? Minimum price per share CPLC should accept from MPLC is 5.95, which is the current book value. Okay. Okay, students. I hope this is clear. Now coming to the second part. Second part, now think it from the MPLC's perspective. What is MPLC getting? There are two things that MPLC is getting. One is the value of CPLC, right? The overall value of CPLC plus because of CPLC coming in, there is a synergy amount also that MPLC is also getting. So the total value of synergy plus CPLC is what the benefit is coming, right? So maximum MPLC can give only up to that benefit that MPLC is getting, right? Maximum price per share MPLC shall be willing to offer to CPLC shall be computed as follows. Okay, which is value of CPLC plus synergy benefits divided by number of shares of CPLC, because they are asking us the per share value, how much per share value that MPLC will give to CPLC, right? So what was the value of CPLC as per residual cash flow method? 35 million, triple five, 556 plus the residual value was 16 triple four triple four whole divided by 5 million. Okay. So this gives us 10.40. So the maximum benefit that MPLC is getting is 10.4 pound per share of CPLC. So this is the maximum amount that MPLC can offer to the CPLC's shareholders. Okay. Now the last part, floor value of CPLC, whether it shall play any role in the decision making. So if you see students, now question is asking us, okay, you have told us that what is the minimum price, what is the maximum price, minimum as per CPLC, maximum as per MPLC. Still, do you feel that is there some floor price that CPLC should say? Yes, that is the current market price because current market price is the lowest, right? So floor value per share of CPLC shall be 4 pound, which is the current market price, and it shall not play any role in decision for the acquisition of CPLC as it is lower than its current book value, right? Okay, students. So Shruti is asking, why are we adding synergy benefit only in max amount? Because synergy ultimately is gained by MPLC, right? If MPLC is to offer something, MPLC will first see that what I'm getting. And what MPLC is getting? The synergy benefit, right? CPLC is actually selling. So from seller's point of view, we don't have to consider synergy. From the buyer's point of view, we have to consider the synergy. Okay, Shruti? Okay. Now, there is one query from the previous day's question of Kumari Jyoti. Question number 4. Question number 2. Yes, question number 4. Okay, so the D value here, D is equal to 88, not 4.5454. Okay, just a second. I think you're talking about subpart 2, if I'm not wrong. Yes, this one. Okay, so this one. So this is the equation, Kumari Jyoti. D is equal to 924 divided by 1134 divided by 20 plus D, correct? This is the equation. Now we have to solve for D here, okay? Now if you solve for D, then first of all, this will go up because it's in division, it's again divided. So it will get multiplied in the numerator and this will come here 1134. So 1134D is equal to 20 plus D 924, right? Now if we solve this, 1134D is equal to 20 into 924. 20 into 924, which is 18,480 plus 924D, right? So you bring this here now. So 1134D minus 924D is equal to 18480. So 1134 minus 924, 210 and 18,480. Wait, this should be, if I'm not wrong, I have mistakenly not mentioned. Just a second. Good point out, Kumari Jyoti. Just a second. Actually, it should be 210 here. I have wrongly mentioned 924. 924 is the overall value, right? So what they will be willing to give is 210 million, which is the market cap of D, right? Just a second, students. Minimum ratio acceptable to the delimited shareholders was number of shares, market cap was 210. Market cap of, just a second. Let me again go through the question. What is the minimum exchange ratio if the P ratio of the combined firm is 9? What is the minimum exchange ratio acceptable to delimited? Right. So delimited was the seller or buyer? Delimited was the buyer. Okay. 15 number of equity shares, market cap 210, combined earnings 126, combined market cap, balance for C limited. Yes. So students, actually, this should be 210 here. I mistakenly mentioned 924. It should be 210. Now you check, Kumari Jyoti, it would be correct. Okay, thanks, Kumari, for highlighting this. Okay, so it should be 210. Why? Because ultimately, the maximum amount that, sorry, the minimum amount that should be acceptable to the delimited shareholders will be the market cap that they are having today, right? For minimum, they should at least get this much amount, which is what they are currently. Okay, got it? Thanks. Now let's come to the next question, which is question number 10. Question number 10, students. X Limited is interested to acquire PB Limited. X Limited is interested to acquire PB Limited. X Limited has 50 lakhs shares of rupees 10 each, which are presently being quoted at 25. On the other hand, PB has 20 lakh shares of rupees 10 each, currently selling at 17. X and PB have EPS of 3.2 and 2.4 respectively. Okay, so they have given us the EPS, the current market price, and the number of shares for both. Okay. You are required to show the impact of merger on EPS in case if the exchange ratio is based on the relative proportion of EPS. Easy to do, right? They are saying that you calculate the exchange ratio, first of all, using the EPS, and then you let us know the impact on the EPS. Okay, so first of all, swap ratio will be EPS of the target company, right? Which is PB Limited divided by EPS of X Limited, right? Which is the acquiring company. So this becomes 2.4 divided by 3.2, right? Which is actually 0.75. So the swap ratio becomes 0.75. Okay. Then now the impact on EPS. So we have to calculate the pre-merger EPS and post-merger EPS, right? So first of all, earnings for X Limited, we have both EPS multiplied by the number of shares. So 3.2 into 50 lakhs is 1 crore 60 lakhs. Then earnings for PB Limited is equal to 2.40 into 20 lakhs. So this comes out to 48 lakhs. So in totality, this is 2 crore 8 lakhs. Okay, so 2 crore 8 lakhs is the total earnings. Total earnings was 2 crore 8 lakhs. Okay, so the total number of shares to be issued basis this swap ratio is how much? Because now for calculating the post-merger EPS, we have now the total earnings, right? We need the total shares. Now for total shares, we already know what are the current number of shares. For the incremental number of shares, we can just simply calculate. So total number of shares to be issued 0.75 into 20 lakhs, right? Which is 15 lakhs. These are the total number of shares to be issued, right? 20 lakhs was the existing share. On that 0.75, 15 lakh plus existing share of X Limited, right? Were how much? 50 lakhs. So in totality, after the merger, 65 lakh will be the new number of shares. Sorry. So 2 crore 8 lakhs is going to be the revised earnings at a totality level because there is no synergy. We are not touching upon that. And 65 lakhs is going to be the numbers. So EPS post merger will be equal to 2 crore 8 lakhs divided by 65 lakhs. So this brings us to 3.20 per share. Yes, 3.2 per share. So EPS post merger comes out to be 3.2 per share. Now we have to show the impact of EPS, right? So statement showing impact on EPS, right? So we will put two things, X Limited and PB Limited, right? So EPS before merger was 3.2 here and 2.4 here, right? Now EPS after merger is still 3.2 here. And for PB Limited, as I mentioned, that because of the swap ratio, we cannot say one share of post-merger X Limited is equal to one share of pre-merger PB Limited. So we have to convert it using the swap ratio, right? So 3.2 is the current price multiplied by 0.75. 3.2 into 0.75, which is 2.4. I hope this is understood. So this is equalized for the one share of PB Limited, correct? Now, if you see, so there is no impact, right? Previously, it was 3.2 for X Limited. Now also it is 3.2 for PB Limited is 2.4. And now also the equivalent amount after the issue of the shares in X Limited, it is still 2.4 students. Okay. Now let's come to the second part. Suppose if X Limited put an offer of share exchange ratio of 1:1, then should PB should accept the offer or not, assuming that there will be no change in the PE ratio of X after the merger. So they are saying whatever is the PE ratio that will remain same. Now you tell us whether they should accept the offer or not. So if you see students, even at 0.75, even at 0.75, it is beneficial to PB Limited, right? because PB Limited is able to maintain the same level of EPS. Okay. So hence, we can say that PB Limited should accept the offer of 1:1 because 1:1 is higher, is better than 0.75. Okay. Should accept the offer as with the 0 point. Okay, let me put PB Limited should accept the offer of 1:1 as with the 0.75 swap ratio also. PB Limited is not at disadvantage. Okay. Then third part, the maximum ratio likely to be acceptable to the management of X Limited. So the maximum what X can pay for PB Limited is what we are supposed to calculate, right? Now again, if you understand it, whatever is the total market value, from that they will reduce the current market value, whatever is that differential that they will be able to pay. Okay. Now, on the third part, which is the maximum ratio acceptable to X Limited. Okay. So first of all, total market value of combined entity. Easy to calculate. How? 2 crore 8 lakhs is the earnings multiplied by the PE ratio, because the PE ratio remains same as is what mentioned in the part B. So what is the PE ratio? 25 divided by 3.2. Right? So 25 divided by 3.2 into 2 crore 8 lakhs. So 1625 lakhs. So let's put here rupees in lakhs. 1625 lakhs. Okay. Then from this, we will reduce the current market price or the pre-merger market value of X Limited. So that is 25 rupees into 25 rupees is the per share value multiplied by 50 lakhs shares. So that is 1250 lakhs. Okay, students. So this comes as 375. Okay. Now this 375 is the maximum is acceptable to the shareholder, which is acceptable to X Limited, right? Because they have seen that whatever is the total value after merging, this is the current market value. So 375 is maximum they are able to pay. Now, if you have to calculate the number of shares, so 375 divided by 25 is the current price, right? And this 375 lakhs. So this comes out to be 15 lakhs shares. Okay. The existing number of shares of PB Limited is how much? 20 lakhs, students. Right? It is 20 lakhs. Thus, exchange ratio is still 15 lakhs divided by 20 lakhs. So which is 0.75 is to 1. Hence the maximum exchange ratio acceptable to shareholders of X Limited is 0.75. So Anush, yes, you can recalculate. Okay. I have not done because see here it was very straightforward. Even at 0.75, it was beneficial to PB Limited, right? But if needed, you can recalculate. That should be okay. By 1:1. Okay. Shareholder of X Limited is 0.75 for one share of PB Limited. Okay, so if you want to recalculate, you can just simply assume the revised EPS from here, right? So this earnings will remain as is, and instead of this, it will be 70 lakhs, right? So basis that you can recalculate. Let's come to question number 11, students. Okay, let me pause for some time so that this can be understood. And Anush, what we will do is we have one more similar question of like this in a separate way. It is drafted. It will come in the existing. It will come in the next questions. So I will tell you. I mean the exact draft. If you're looking for, then we will discuss that, Anush. Okay. So Prashant is no Prashant. There is no synergy gain in this, right? Or there is no need also to calculate synergy gain. Correct, because how we have equated is whatever is the amount left, which is 375. So 375 will include the value assigned to the target company as well as the synergy gain that target company is bringing to us, right? So there is no need to calculate it separately here. Okay. See, again, I'm saying students, there is no set steps or there are no standard way of solving these questions, right? Because these questions are very unique. Each and every question is very much unique. So I would suggest that we have to just strictly follow what question is saying, right? And then accordingly devise our solution. Correct? B Limited is a highly successful company and wishes to expand by acquiring other firms. It expects high growth in earnings and dividends is reflected in the P ratio of 17. So it is saying that 17, since 17 P ratio is there, it is very high. So that means the higher growth is expected in the years to come. The board of directors of B Limited has been advised that if it were to take over firms with a lower PE ratio than its own, using a share for share exchange, then it could increase its reported earnings per share. And so this has been informed to them. C Limited has been suggested a possible target for a takeover which has a P ratio of 10, that is a lower P ratio against 17, correct? And 1 lakh shares in issue with a share price of rupees 15. B Limited has 5 lakh shares is an issue with a share price of 12. Calculate the change in earnings per share of B Limited if it acquires the whole of C Limited by issuing shares at its market price of 12. Assume the price of B Limited remains constant. So now it is saying that the price of B Limited remains constant before and after acquisition. Okay. So let's start. First of all, we have to calculate the EPS, right? So this is the B Limited company and this is the C Limited company, right? B Limited is acquiring C Limited. So the PE ratio, here it is 17 and here it is 10. Number of shares, here it is 5 lakhs, here it is 1 lakh. Market price per share, here it is 12 and here it is 15. So if we have to calculate the earnings, right? If you have to calculate the earnings, then we might have to use the PE ratio, right? So earnings here will be 1 lakh into 15. So this is the total market value divided by the PE ratio. Okay, so this comes 1,50,000. Similarly, here if we calculate, then it is 5 lakhs into market price per share divided by PE ratio. So this comes as 352,941. Okay, these are the earnings. Okay, now swap ratio is mentioned in the question has to be basis the price. So it becomes price of C Limited divided by price of B Limited. Okay, students. So this is how much? 15 by 12. 1.25 is to 1. So the total number of shares to be issued by B Limited is 1.25 multiplied by the existing number of shares, which is 1 lakh, right? So it becomes 1,25,000. Okay. And total shares in B Limited after merger becomes how much? 5 lakhs plus 1,25,000. So in totality, it becomes 6,25,000. Then let's come to the EPS after merger, right? We've calculated the before merger earnings in totality, right? So that will get totaled. So which is 352,941 plus 1,50,000 whole divided by 6,25,000, right? So EPS post merger becomes 0.80. Okay. And present EPS for B Limited was 352,941 divided by 5 lakh shares, which is equal to 0.71. So EPS for B Limited is increased from 0.71 to 0.80. So students, if you see whatever it was told to the board of directors that if you acquire a lower PE ratio company, your earnings will increase. It could increase its reported earnings per share, right? It was mentioned. So this has finally been proved that EPS for B Limited is increased from 0.71 to 0.80, right? The existing one was 0.71. The new one is 0.80. I think that was only was the question it was asked. Calculate the change in the EPS of B Limited, right? Assuming if it requires the C Limited. So the change is 0.09 per share. It has increased, right? From 0.71 to 0.80. Students, any questions till now? Please do let me know. I hope this was fairly easy question. Nothing I have much. So if the question is indicating you to calculate the impact on EPS, please calculate it. This is that. If the question is indicating you to calculate the impact based on the MPS or the market value, we can take that. Sometimes for the combined entity, we have not been given or we are not specifically given the P ratio, right? We are given the P ratio for the acquiring company and the target company. Now, in such a case, we always assume the post merger PE ratio to be the same as that is of acquiring company, right? We assume it to be the same, students. Question number 12. Elrond Limited plans to acquire Doom Limited. The relevant financial details of the two firms prior to the merger announcement are: they have given us the market price and the number of shares outstanding. The merger is expected to generate gains, which has a present value of 200 lakhs. The exchange ratio is agreed at 0.5. Now they have specifically given us a present value of gains of 200 lakhs. This is the synergy gain. What is the true cost of merger from the point of view of Elrond Limited? So if there is a cost from the point of view of Elrond Limited, that means they are asking us to calculate the gain from Doom's point of view, right? Whatever is the gain to Doom's is the cost for Elrond, right? As we have discussed in our previous session also. So let's start, students. Swap ratio is 0.5 is to 1. Simple. So shareholders, or in a way, shares to be issued to Doom's Limited shareholders will be 0.5 into 10 lakhs. Okay, which is 5 lakh shares. Easy. And hence the percentage of Doom Limited in overall capital will become 5 lakhs divided by 20 are the existing shares in Elrond Limited. 5 will be further issued. So 5 divided by 25, right? Which is a 20%. So 20% of the overall holding will go to Doom Sim Limited, which will be a company emerging post the merger, right? Now, can we also calculate what is the value post merger? Yes, we can calculate. What was the Elrond Limited value? 50 into 20 lakhs. Correct. What is the Doom Limited value? 10 into 25. So 10 lakhs. In a way, 25 is the price and 10 lakhs are the number of shares. Plus 200 lakhs is the present value of synergy gain. So 1450 lakhs becomes the value post merger. Correct. Now within this value, this will get split into two, right? 80% and 20%. 20% will belong to Doom. 80% will belong to Elrond. Now, as I told you, the true cost of merger from Elrond point of view will be the gain to the shareholders of Doom. Now, gain to the shareholders of Doom will be 20% in this 1450 is what they are actually. Okay, so let me write down the formula. True cost of merger will be calculated as 1450 into 20% minus What was their initial value before merger? 10 lakhs into 25. So don't you think this is a gain to the shareholders of Doom Limited? That means it is a cost from the point of view of Elron Limited. This becomes 40 lakhs. Okay. So the true cost becomes 40 lakhs, students. Clear, students? Any query? Please do let me know. Next question. Question number 13. MK Limited is considering acquiring NN Limited. The following information is available. Earnings after tax, number of equity shares, and present market value per share. Exchange of equity shares for acquisition is based on the current market value as above. Okay. There is no synergy advantage available. Find the earnings per share of company MK Limited after merger and find the exchange ratio so that the shareholders of NN Limited will not be at loss. Okay, so first of all, they are saying that the current market value will be used to exchange the equity shares, students. Can we calculate the current market, or can we calculate the current swap ratio? Calculation of swap ratio. Because once we are able to calculate the swap ratio, then we can calculate the EPS post merger. Okay. So calculation of swap ratio, MPS, is how much? 160 of the target company and 200 is for the acquiring company. So 160 divided by 200, students, right? So this is 0.80 is to 1. So the number of shares to be issued, I can say basis MPS. Okay. Swap ratio we have calculated basis MPS. Now number of shares to be issued into 3 lakhs. Correct? So this becomes 2,40,000 shares. Total shares post merger becomes how much? 2,40,000 plus. What are the existing number of shares? 12 lakhs. 14,40,000. Okay, so the earnings are how much? 60 lakhs and 18 lakhs for calculating the post-merger EPS, right? So the total is 78 lakhs. EPS after merger will be 78 lakhs divided by 14 lakh 40,000. So this becomes 5.42 per share, students. Okay. So this is the exchange ratio. And this is the EPS. Find the earnings per share for the company after the merger. So that we have calculated 5.42. Simple, right? It's not asking us to calculate the effect on EPS. It's just asking to calculate the EPS. Now, second is if exchange ratio to be based such as NL Limited would not be at loss. So exchange ratio basis EPS. So if we see what is the EPS here, okay? So 60 lakhs divided by 12 lakhs. 5 rupees is the EPS for MK Limited and 18 divided by 3, 6. So don't you feel if the ratio is calculated basis EPS, NN Limited will not suffer any loss? Reason being, NN Limited will enjoy a higher swap ratio, right? Let's see how. Basis EPS. EPS of NN Limited, EPS of MK Limited, which is 18 lakh divided by 3 lakhs. Okay, whole divided by 60 lakhs divided by 12 lakhs. So this is 6 by 5. So the number of shares to be issued by MK Limited, six by 5, okay, into 3 lakhs, which is 3,60,000. And EPS after merger will become 78 lakhs were the profits, right? Divided by 15,60,000, which is 12 lakh of the existing equity shares and 3,60,000 are the new equity shares. So this is 5, right? EPS becomes 5. Now, what is the earnings available for equity shareholder of NN Limited? 3,60,000 is the number of shares that they are holding, and 5 rupees is what they are having a EPS after merger. So that becomes 18 lakhs again. So they are able to get back 18 lakh rupees as the amount. Okay. So in a way, they are not suffering any loss. If the exchange is basis the EPS, they are not suffering any loss because pre-merger also their earnings that they were getting was 18 lakhs. Post-merger also they are getting 18 lakh students. Okay. Now, if you see students in this, sorry. Sorry. So in this question, if you see, now what will MK Limited will be interested to offer, right? There are these two names, na? MK Limited and NL Limited, right? So NL Limited will push for a swap ratio of 6:5. However, MK Limited will push for a swap ratio of 0.8:1, right? So 6:5 is how much? 1.2:1, right? So they will start from here and somewhere they will close the deal, let's say 1.1:1 or 1:1, somewhere like that. Correct? That's how the deal will happen. Right? That's how the deal will happen, students. Okay. Let's move ahead. Question number 14, students. The CEO of a company thinks that shareholders always look for EPS Therefore, he considers maximization of EPS as his company's objective. His company's current net profits are 80 lakhs and the P multiple is 10.5. He wants to buy another firm which has a current income of 15.75 lakhs and a P multiple of 10. Okay. So they have given us the earnings and the P ratio of both the current company, I mean the acquiring company and the target company. What is the maximum exchange ratio which the CEO should offer so that he could keep EPS at the current level, given that the current market price of both the acquirer and the target company are 42 and 105 respectively. And in the next step, so this is part one. The next part is if the CEO borrows funds at 15% and buys out target company by paying cash, how much cash should he offer to maintain his EPS? Assume tax rate to be 30%. So the next part has more to do on the cash payout. The first part has more to do on the equity issues, equity shares issued for the discharge of purchase consideration, right? So let's first of all organize this question. So this is the acquiring company, this is the target company, okay? PE multiple is 10.50 here and 10 here. Net profits is given as 80 lakhs and here it is given as 15.75 lakhs. Okay. Then market price per share is also given to us, which is 42 and 105. So using MPS and PE multiple, can we calculate EPS? Yes. Earnings per share will become 42 divided by 10.50, which is I think 4. Similarly, here it will be 105 divided by 10, which is actually 10.5 students, right? So now using this EPS and the net profits, using EPS and net profits, can we calculate the number of shares? Yes, we can calculate the number of shares. So this will become 80 divided by 4. This will become 15.75 divided by 10.5. So this is actually 10 lakhs shares calculated from here. Sorry, 20 lakhs shares. This will be 1.5 lakh shares calculated from here. Okay, students. So till now, the calculation was easy, right? We have just organized the data in a usable manner, which we will use it. Now, the question says that what is the maximum exchange ratio which CEO should offer so that he could keep the EPS at the current level? What is the current level EPS? 4 rupees, right? So can we say that let the number of shares to be issued to target company be X, then EPS will be how much? 4 rupees is equal to what is the total earnings? 80 lakhs for the acquiring company plus 15.75 lakhs for the target company whole divided by 20 plus X. 20 are the existing number of shares and X is the new number of shares. Any doubt till now, students? Any query or any doubt till now? Please do let me know. So if we solve this, X becomes 393 750 shares. So these much shares needs to be issued, and hence the exchange ratio will become 2.625 per share. This is the exchange ratio, students, of target company. So for every one share, the company will issue 2.625 number of shares. Okay, clear? Again, students, any questions from all of you? Shailesh, Mancha, Shruti, Viraj, Kumari Jyoti, Anush, Prashant, all of you have logged in, or anyone else also who has not replied till now. Any question or any query till now, please do let me know. Then second part is actually if the CEO borrows funds at, now the second part is talking about the cash payout, students, right? So the cash payout, whenever it will happen, it will lead to the lower profits, right, in future, because you will end up giving up this 15% amount, right? So we have to adjust for it. Again, we will let us assume cash payout to be X. So 4 will be equal to, okay, Shruti, Shailesh, thank you. So then 4 will be equal to 80 lakhs plus 15.75 lakhs minus X into 15%. This is the amount that we will lose, right? On the cash payout, we will lose X into 15%, but there will be a tax adjustment also, right? On this, we will be able to save 30% on account of tax. Okay, that is why we have reduced 1 minus 3, 30%. And overall divided by 20 lakhs, because the shares are going to be the same, students here, right? So here it becomes 95.75 lakhs minus 10.5. Wait, let me just put 0 point, instead of percentage, I am putting 0.105. X is equal to 80 lakhs. So X becomes 150 lakhs. Simple. So X becomes 150 lakhs. So 150 lakhs is what we need to pay in cash so as to maintain the same EPS, right? So as to maintain the same EPS of 4 rupees. Next question, students. Question number 15. XYZ Limited wants to purchase ABC Limited by exchanging 0.7 of its share for each share of ABC. Relevant financial data are as follows. Okay. So equity shares outstanding, EPS, and market price is given. Illustrate the impact of EPS on merger of both the companies. Students, please note, I think this is for XYZ. It's not mentioned here. Please note this. And this is for ABC. Okay. Now, students, and specifically Mr. Anush Shanbhog, right? You have asked one question where I said that there is a similar question I will be taking up. Now you see the presentation of this question. Okay, Anush, you can adopt the same presentation because the question is very much on the similar lines to what we have discussed, right? See, here also they have changed the exchange ratio to 1:1. And in the first part, they are again asking us to calculate the impact of merger on EPS, right? So what was your question? Just see the presentation to apply. Now, first of all, we have been given equity shares, EPS, and market price of both the companies. We have to illustrate the impact of merger on EPS of both the companies. For that, we have to calculate the pre-merger EPS, which is already there, 40 and 28, and the post-merger EPS translated into XYZ and ABC relatively, whatever is the amount coming out to be. Okay, so let's start with the first part. Impact of merger. XYZ Limited, ABC Limited. Okay, so let's start, students. Number of shares. Here it is 10 lakhs and here it is 4 lakhs. Now the EPS is 40 rupees and here it is 28, right? So the earnings overall becomes how much? Why do we need overall earnings? Because then only at a merged entity level, we will be able to calculate the EPS, right? So 40 into 10 lakhs. So this becomes 400 lakhs. So 40 into 10 lakhs, right? Similarly, 28 into 4 lakh, 112 lakhs. So 28 into 4 lakhs. Okay. Now, can we calculate the PE ratio? Since we have market price, can we calculate the PE ratio? Yes, we can calculate the PE ratio. 250 divided by 40. 250 is the market price, right? And 40 is the EPS. So 6.25 is the PE ratio. 160 divided by 28. And 5.71 is the PE ratio here. Okay. P ratio is calculated. Now, since we have the swap ratio already, so issue of shares 0.70 is the swap ratio on 4 lakhs shares of the target company. So it comes as 2,80,000. So EPS post merger becomes 400 plus 112 lakhs. This is the combined earnings divided by 10 lakhs are the existing number of shares for XYZ Limited, right? And 2,80,000 is what we are going to issue next. So EPS post merger becomes 40 rupees. So EPS post merger, students, becomes 40 rupees. So let's do the analysis impact on account of EPS, right? For both XYZ and ABC. So EPS after merger for XYZ, the ratio will always be 1:1, right? But for ABC, it is going to be 40 into 0.70, which is 0.70 is to 1, right? So this becomes 28. Before merger, right? So EPS before merger is actually, here it was 40 only, right? And here also it was 28. So the impact is nil. Okay. So the first part is done. First part is done. Now let's come to the second part, students. And this second part now is very much similar to what I was mentioning to Mr. Anush, right? That we have done in, I think, in question number 10. Question number 10, second part. The management of ABC Limited has quoted a share exchange ratio of 1:1 for the merger, assuming that the P ratio of XYZ Limited will remain unchanged after the merger. P ratio we have already calculated before the merger. So they are saying it will remain same. What will be the gain from merger for ABC Limited? So let's calculate first the revised EPS post merger, assuming 1:1. So if exchange ratio is 1:1, so the EPS will be 400 plus 112. The earnings remains same. And in the denominator, it will be 10 lakh plus 4 lakhs. Correct? So this becomes 36.57 per share. Now, the PE ratio remains unchanged. PE ratio is how much? 6.25. So MPS post merger becomes how much? 6.25 multiplied by 36.57 per share. Understood? Correct. So this becomes 228.56. This becomes MPS, market price per share. Now, if you really see what is the gain to shareholders of ABC Limited, which is the target company, right? The same thing we could have done in the question number 10th, right? So this we will calculate how? So 228.56 is the revised price of one share, right? Why I'm taking this as is because the ratio is 1:1. Had the swap ratio not been 1:1, we would have multiplied this 228.56 with the swap ratio to arrive at the equivalent price minus what is the pre-market value for ABC Limited, 160. This one, right? So at a market price level, they have gained by 68.56 per share. So now if you see, we have utilized the same PE ratio, the fact of same PE ratio. We have utilized the fact of 1:1 exchange ratio, and hence using that we have computed the EPS. And with that, we have calculated the gain to the shareholders of ABC Limited. Now, had we been in question number 10, we would have done the same calculation, exactly same, only the numbers would have been different. And then we could have mentioned that since the gain to shareholders of ABC Limited is this much, it is okay for the shareholders of ABC Limited to accept the proposal. Okay, understood. Anush, I hope I answered your question. Guram, can we verify 150 lakhs cash? Okay, Guram, you're asking about the previous question. Yes, you can verify. If you put it in the same equation and calculate the EPS, you will be arriving at 4. Okay. So question number 15th, second part is also done. Now let's come to the third part. What will be the gain or loss to the shareholders of XYZ Limited? Now it is asking the gain or loss from the point of view of XYZ Limited students. Let's compute. Gain slash loss. To shareholders of XYZ Limited. Now students, tell me, basis the revised exchange ratio, we have calculated the MPS, right? Market price per share, which was around 228.56. Now using that, can we further calculate what is the impact to the price of the XYZ Limited shares? Yes. So market price of the merged entity, 228.56 minus market price of the XYZ entity before merger. It was how much? 250 rupees, if I'm not wrong. Yes. So XYZ's price before merger was 250 rupees. So students, if you see, there is a loss that has been incurred to shareholders of XYZ Limited, loss from merger, right? 21.44 rupees. Agreed? So the third part is clear, students, wherein the loss has become, okay, because they have agreed for an exchange ratio of 1:1. However, they are getting a earning of only 28 compared to the 40 earnings that they have, right? So this is bringing them to trouble, right? However, ABC Limited is enjoying because as per ABC Limited, the correct ratio should have been 0.7, but they are still getting more than 0.7, which is 1:1. Okay. Now, last, determine the maximum exchange ratio acceptable to the shareholders of XYZ Limited. Now, finally, they're asking, okay, if third part there is a loss, then what is the maximum ratio acceptable to the shareholders of XYZ Limited? Simple. Let's compute that. Again, just think how will XYZ Limited compute that number? It will first of all compute the overall market value of the new entity. Then it will reduce its existing market value. That whatever is the addition, to that extent, it will be able to issue the shares, correct? Just the same approach we followed in, I think, question number 11, where there a question came that we don't need to, do we need to calculate the synergy value? I said no, because the value that they are getting ultimately is reflective of two things. One is the value of ABC Limited plus the synergy value itself. Okay. So the total earnings are 400 plus 112, which is 512 lakhs, right? Then PE ratio is still 6.25 times, right? So the market value by multiplying total earnings and PE ratio, so 512 into 6.25 is 3200 lakhs, right? So how have we calculated? 512 lakhs multiplied by 6.25 times. Clear? Minus value of XYZ Limited before merger. how much was the value? 10 lakhs number of shares and 250 was the price. So 2500 lakhs was the value. So that means how much value addition has happened, maybe because of synergy or maybe because of the value of ABC Limited itself without any synergy, is in totality it is 700 lakhs, right? So the maximum that XYZ Limited should settle to ABC Limited is 700 lakh, students, right? Value of merged entity is this much. Market price, it was mentioned that it will remain same, right? So 250 is the market price. If we divide it, then the number of shares that we arrive at is 700 lakhs divided by 250, which is 2.8 lakhs. And hence the maximum exchange ratio becomes 2.8 is to 4 lakhs, right? These are the total number of shares, students. So this again comes out to be the same, which is 0.7 is to 1. So in a way, what we have quoted earlier, the same ratio should have been used so that the value is not lost from the point of view of XYZ Limited. Correct? Because XYZ Limited will prefer such values which will lead to the which will not lead to any losses. Correct? If 1:1 is the ratio, then they would have been suffering losses to the tune of what we have understood, right? So I hope, students, this is clear. Specifically, Anush Shanbog, your query, right? On the presentation part, you can adopt the same presentation for this question number 10 also. Okay. At least for the first and second part, which are very much similar. So students, let's take a 10 minutes break. It's 8:28. Let's again reconvene at 8:38. Welcome back, students. We left till question number, we did till question number 15. Now let's start question number 16. Yes. So question number 16 is Longitude Limited is in the process of acquiring Latitude Limited on a share exchange basis. Following relevant data are available. PAT is available for both longitude and latitude, number of shares, earnings per share, then price earnings ratio, and it is also mentioned that ignore synergy, right? You're required to determine the pre-merger market value per share. That is the easiest thing to do, right? The maximum exchange ratio Longitude Limited can offer without the dilution of EPS and MVS both. Calculate ratios up to 4 decimal points and amounts and numbers of shares up to 2 decimal points. Okay, which is fine. So longitude and latitude, students. So let's start, students. First of all, we have to calculate the pre-merger market value per share. So we have been given PAT 120 and 80, number of shares 15 lakh and 16 lakh. So the earnings per share straight away becomes 120 divided by 15, which is actually 8 per share, and 80 divided by 16, 5 per share. The PE ratio is also given to us. How much is the PE ratio? 15 and 10. So can we calculate market price per share? Yes. So 8 into 15 is equal to 120. And here 10 into 5 is equal to 50. So these are all pre-merger EPS. So the first part is done. Now the second part is saying that EPS need not be diluted. Then what is the exchange ratio? So second part, calculation of exchange ratio. In this subpart A is that EPS sorry, EPS to be same. Okay. In such a case, what will happen? Let the number of shares be X, right? So 120 plus 80 is what we will get in the form of PAT, right? Then divided by 15 is the existing number of shares, X is what we have assumed, and EPS is 8. Simple, students. I hope this is simple and easy. If we solve this, X comes out to be 10 lakhs, right? This is 10 lakhs actually. So 10 lakhs shares for 16 lakhs shares that have been already issued, right? These are the 16 lakh against this 16, 10 lakhs are being issued. So the exchange ratio comes out to be 10:16. Okay, 10:16. So that is 10 divided by 16 is equal to 0.625:1. So students, please note that we were told to calculate 4 decimal points, but since only 3 decimal points are there, so we will restrict it to there. Okay. Then the second part, they are saying MPS to be same. For MPS to be same, we will take the total market values of both the combined entities, right? Without taking any synergy benefits and divided it by the number of shares. So 120 into 15 plus 50 into 16 divided by 15 plus x is equal to 120. So 120 into 15 is how much? This is actually the MPS into number of shares. Similarly, 50 into 16 is also the MPS into the number of shares that will give us the total market value. Divide by the 15 plus x. So here also we are assuming let the new equity shares to be x. Okay. So here x becomes 6.67 lakhs shares. Okay. So in this case, the ratio is 6.67 divided by 16 or 6.67 divided by 16 or 0.4169:1. So this is the 4 decimals that we have to put. Okay, students, that is mentioned in the question. And hence I have put the 4 decimals in this case. So Kumari Jyoti is saying how to know that synergy benefit is there. Okay, Kumari, if let's say in some of the questions, if we add the market value of A and B and it is not equal to the market combined value, hence it is an indication, basis the facts that are given in the question, it is an indication that there is a synergy benefit. Now, in some cases, the combined value is not given. We have only been given the individual values and synergy benefit is separately given. So while calculating the combined values, individual values plus synergy value is equal to combined value. This is the second type of question. Third type of question is where the combined value is also given and the individual values are also given, and it is mentioned that there is no synergy benefit, like this specific question, right? Or I think the previous question where it was mentioned that there is no synergy benefit, correct? So we have to go again with what is best available in the question as facts. Kumari, okay? Guram is asking what is the diluted share means. Okay, so Guram, diluted share means that they don't want to reduce. So here dilution means they don't accept a reduction in EPS or market value per share. They don't accept a reduction there. They would always want these values to be on a higher note. Or not on a higher note, but at least whatever they are earning, they should be preserved at that level. Okay. Now, Kumari Jyoti, to answer your question, in this, right, it's not mentioned specifically anywhere that there is any synergy or see, here it is mentioned, ignore synergy, right? So that means we have to ignore synergy, right? So we'll have to go with what it is mentioned in the question. Question number 17, students. Yeah, this is a very good question, students. Now, Simple Limited and Dimple Limited are planning to merge. The total value of the companies are dependent on the fluctuating business conditions. The following information is given for the total value, and they have explained you what is the meaning of total value, debt plus equity. Structure of each of the two companies are as follows. In three different business conditions, having three different probabilities, they have given us the simple limited and dimple limiteds, different amounts. Okay. And they have given us the current debt of 65 lakhs, and for simple limited, it is 460 lakhs. Calculate the expected value of debt and equity separately for the merged entity. For the merged entity, they are asking us to calculate the expected value of debt and equity, students. Now, please understand, the equity of Dimple Limited and Simple Limited will be combined in the merged entity. Why? Because for this value of equity, they will be issuing a purchase consideration in the form of cash or in the form of equity share that will again add to the equity value of Simple Limited, right? If let's say Simple Limited is acquiring. Okay, so this is a very unique question, students. Now, I want all of you to tell me how to go about this. Can anyone tell me how to go about the solution for this, students? Should I simply compute the total value, what is expected, right? That means multiply the probabilities with this, come at a total value, and then split it between the debt and equity, right? Or do you feel that is there any other way? How should we approach this question, students? Tell me. Just think through and then tell me, and see the numbers also once. I'm just giving everyone a bit of time to let me know. Yeah, students. So how should we approach this, students? Should we, because see, it's mentioned as expected value of debt and equity. See, we have one thing very clear. We have Simple Limited and we have Dimple Limited, right? Now we can add both of them. Let's say 820, 550 and 410 multiply with the respective probabilities, right? Similarly, for Dimple Limited, we will come to a value and then we can split that into a debt and equity again. This is one approach. But if we do this, then what is the basic problem here? The basic problem is that the current debt of Dimple is 65. So everywhere 65 is okay because the total value is inclusive of debt. Yes, Viraj. Viraj has mentioned the correct part. Very good, Viraj. So that is what I'm trying to explain. If 65 is there in this total value, it is still okay because the total value is higher than the debt. But in case of Simple Limited, for debt of 460, the total value is only 410 for a slow growth period. Now see, okay, Prashant, that's what I'm trying to explain. The last part is where we have to be really careful. How come it is possible that I am having a debt of 460, but my total value is only 410? That means the equity is 0 and the revised debt will become 410. Correct? Because we are talking about a company. A company has a limited liability, right? And whatever is the amount, first of all, the debt will be paid off before equity. Debt amount to be paid off is 460. but your balance sheet is only having 410. So that means you will not be able to pay balance 50. And you cannot call for another 50 from the equity shareholders because equity shareholders have a limited liability, students. Okay, so this is the catch. Now, see how we can solve this. So solution, first of all, we will break up the value of individual companies into debt and equity. So for Simple Limited, let's take high growth, medium growth, and slow growth, right? These are the three business scenarios that are given to us. What is the total value that they've given to us? For high growth, it is 820. And this is all in rupees in lakhs, if I'm not wrong. Yes. So let's mention rupees in lakhs. Okay. So 820, medium growth is 550. Then it is 410. Then we will separate out the debt first. See, in all the cases, debt will remain same. High growth, if the value turns out to 820, the debt will still be 460. Medium growth, instead of 550, the debt will be 460. Now, in case of slow growth, the debt will go and gets revised to 410, students. This is a point to be noted because we cannot say that with a 410 of the total value, we can discharge a debt of 460. How we will do that? We cannot call for extra money from the shareholders, right? So the balance value becomes the equity value. How much is the equity? 360. 550 minus 460, which is 90. And then nil. Okay. So we can mention through the star minus 50 in equity is not possible because of limited liability clause, and hence the value of debt stands out to be rupees 410. Yes, Kumari Jyoti, you are also right. Perfect. Okay. Now, the similar breakup that we did for Simple Limited, we will do it for the Dimple Limited. High growth, medium growth, slow growth. What are the numbers? So the total value 1050, 825, and 590. Debt 65, 65, and then 65. And finally, the equity is 985, 760, and 525. Okay, so the total value is this much, debt is this much, and hence the equity becomes this much. Calculation of expected value of debt and equity. Now we will do this calculation, students, right? First of all, we have separated out the debt and equity portion of Simple and Dimple Limited. Now we will assign the probabilities, multiply whatever the probabilities are assigned, we will multiply to arrive at the expected value of debt and equity. So for Simple Limited, again, high growth, right? What is the debt value and the respective probabilities? So high growth has a 20% probability with a debt value of 460. Medium has a 60% probability with a debt value of 460. And slow has a possibility of 20% with a 410 value. Okay. So we add this, total debt becomes how much? So this plus this is equal to 450 is the total debt. Then comes equity. For equity, we have a 20% probability of 360. Then 60% probability of 90 plus another 20% probability of 0, right? So this becomes, total equity becomes 126. So Simple Limited total debt, or I can say expected total debt and expected total equity, right? Now coming to Dimple Limited. Here the debt remains same, right? What is the debt? 65, 65, 65. So 0.20 into 65, again 0.60 into 65, 0.20 into 65, right? So hence the total debt on account of Dimple Limited is 65. Now let's go to equity. So 20% are the chances for equity being 985. 60% are the chances for equity being 760. And another 20% chance for equity being 525. Okay, so the total equity expected equity is equal to 758, students. So the expected total becomes 823. This is the total of equity plus debt. In case of Simple Limited, it was total expected value. Equity plus debt was how much? 576. Okay. So 823 and 576. Now let's come to the value of merged entity. Okay, so the value of merged entity, students, becomes equity from Simple Limited and Dimple Limited. How much it was? 126 is the equity of Simple and Dimple's equity is 758. So the total is 884. Okay. Now debt is sorry, Simple Limited and Dimple Limited. It becomes 450 and 65 students. Right? So this is actually 515. Perfect. So these are the answers. I hope this is clear, students. Understood? So the only catch here was that since the total value was a bit lesser in the last business condition, slow growth for Simple Limited, we have accordingly calculated it separately. Otherwise, if you calculate split or if you calculate at a combined level, the answer would have been same, right? But in this case, there is a little bit change in the answer, students. Okay, let's move ahead. Any questions till now, students, or any other thing that you want to discuss or say? We can probably discuss that. Okay, the next question is, the following information is provided relating to the acquiring company, Efficient Limited, and the target company, Healthy Limited. Okay. Okay, Shruti, perfect. So there is a acquiring company called Efficient Limited and it is planning to acquire Healthy Limited. Now the number of shares having a face value of rupees 10 each, they have given us 10 lakhs and 7.5 lakhs. Market capitalization of 500 lakhs and 750 lakhs is also given. PE ratio is given. Reserves and surplus, which is a 300 lakhs and 165 lakhs is also given. And this time they've also given us the promoters holdings, right? Which is the number of shares out of which the total shares 4.75 is held by the promoter. So out of 10 lakhs, 4.75 is held by the promoter, which is 47.5%. And in case of Healthy Limited, 5 lakhs from total of 7.5 lakhs is held by the promoters. So board of directors of both the companies have decided to give a fair deal to the shareholders, and accordingly for swap ratio, the weights are decided as 40%, 25% and 35% respectively for earnings, book value and market price of the shares of each company. So they are going to follow three different methods for arriving at the swap ratio, students. So the first method is the earnings method. The second method is the book value method. And the third method is the market price method. And then once we have the swap ratio basis all these three, we will compute the overall swap ratio by applying the weights. Okay. So first part is calculate the swap ratio and also calculate the promoter's holding percentage after acquisition. Okay, so because the swap ratio will be applied on the total number of shares for Healthy Limited, even it will also get applied on the promoter's holding of 5 lakhs to arrive at the overall swap ratio. Okay, so yes, students, let's first of all plot the basic information. So the market cap is 500 lakhs and 750 lakhs. So students, we have to just organize the data in such a manner that first of all, we get earnings, book value and market price. Okay, so that we can calculate the swap ratio for all these three things. Okay, so the number of shares is given as 10 lakhs and 7.5 lakhs. Hence, the market price per share becomes 500 divided by 10, which is 50 per share. And here it becomes 750 divided by 7.5, which is 100 per share. So the market price comes out to be 50 and 100 per share. Now MPS is done. We have to calculate the earnings, right? EPS. So for earnings, let's use PE ratio. Correct. So PE ratio is 10 here and 5 here. So 50 divided by 10 will give us the EPS divided by PE ratio. Correct. So 50 divided by 10 gives us 5. And 100 divided by 5 gives us 20. And hence the profits are 10 into 5 and 5 into 20. 50 and 20 into 5. Sorry, my bad. This is P ratio, not the number of shares. Sorry. So EPS is fine, 5 and 20. Then profits will be earnings per share multiplied by the number of shares. So 10 lakh into 5. And similarly, here it will be 20 into 7.5 lakhs. So this will become 150 lakhs. Okay, so the profits becomes this much. Then MPS we have calculated, EPS we have calculated. We have to now calculate the book value, students, right? So the total book value. Okay, before total book value, let's go to the share capital and reserve and surplus separately. Share capital is actually 100, right? 10 into 10 and 75. So 10 lakhs into 10 rupees each. 7.5 lakhs into 10 rupees each. So here it is 75 and here it is 100. Right? Then reserves and surplus. Reserves and surplus is how much? 300 and 165. So this becomes 400 and this becomes 240. Again, all this is in lakhs. Okay. So 400 and 240 lakhs. Okay, students. Now we can calculate the book value per share. Book value per share is how much? If 400 is the total value, divided it by the total number of shares, right? 10 lakhs, right? So the book value becomes 40. And here 240 divided by 7.5, which is 32. Now, all the three different values that are going to be used for swap ratio has been estimated, students, right? Perfect. So can we calculate the swap ratio now? Yes. So for swap ratio, let's first of all calculate basis the earnings. Basis the earnings, we have EPS of 20 and 5, right? 20 is for the target company and 5 is for the acquiring company. So it becomes 20 divided by 5, which is 4:1. There is a weight attached to it, right? Earnings are at how much weight? 40 is for earnings, 25 is for book value, and 35 is for the market value. Okay. So 40%. So weighted ratio becomes how much? So 4:1 into 40%. So 4 into 40%. So 1.6 is to 1. Let's go to the second part now. Second part, let's take use of book value. So the book value of target company is 32, acquiring company is 40. So 32 divided by 40, which is 0.4 is 4:5, which is 0.8:1. 4 divided by 5 is 0.8:1. And this has a weight of 25%, students. So this becomes 0.2:1. Then C part, market price per share. Market price was 150. 100 was for the target and 50 was for the acquiring company. So this is 2:1. And this has a 35% ratio. So 0.7:1, right? If we total it, so 0.9 and 1.6. So 2.5:1 is the ultimate ratio, right? Total ratio. So the swap ratio basis above calculation is 2.5 shares is to 1. Okay. So for every 1 share of Healthy Limited, Efficient Limited will issue 2.5 shares of its own. So now first First part is done. Now the second part is also calculate the promoter's holding percentage after acquisition. Okay. Now within this, so first part itself, but sub part B, which is the promoter's holding. So how can we calculate the promoter's holding, students? Already for efficient limited, we will take as is. For healthy limited, we will multiply with the swap ratio. Correct? So number of shares held by promoters post merger is equal to 4.75 lakhs were the initial amounts, right? 4.75 lakhs were the initial amount. And in 5 lakhs, we have added 2.5 times, right? In 5 lakhs, we will have to issue 2.5 times of the number of shares, because 5 lakhs was the promoter holding in the previous company. So for every 1 share, promoter will get 2.5 times. So in totality, this will become 7.25 lakhs, because 2.5 into 5 is 12.5 plus 4.75. So this becomes 17.25 lakhs. And total number of shares post merger, students, this will be how much? 10 lakhs as is plus 2.5 times on 7.5 lakhs. Correct, because the next 7.5 lakhs, so the overall 7.5 lakhs for healthy limited will attract a issue ratio of 2.5 times, right? So 7.5 into 2.5 gives us 18.75 plus 10. So 28.75 lakhs, right? If the total number of shares are 28.75 lakhs and the promoter's holding is 17.25, then can we calculate the percentage promoter's holding? 17.25 divided by 28.75. This is also lakhs, this is also lakhs, right? So 17.25 divided by 28.75 is actually 60%, students. Students, any question till now? Okay. I was actually expecting this question while I was totaling this. I will explain that, Viraj. Okay, so the first part is clear, students. So there is a question from Viraj that in the weighted ratio, while we have added 1.6, 0.2 and 0.7, why have you not added 111? Yeah. Sorry. Why we have not done that, Viraj? See, can I write this as 1.6 divided by 1 plus 0.2 divided by 1 plus 0.7 divided by 1? Correct? This is what the ratio means. This is what 0.7 is to 1 means. Correct? So if I have to solve for this, correct? Applying the principles, I will just take, because all the denominator is by 1, I can just take by 1 and add like this, right? In the numerators. So that is why we have just added the numerators to arrive at this ratio. Okay, Viraj? You cannot add the denominator. Okay? And thanks for highlighting this, because this might be a question from many other students also. Okay, students, now this is done. Let's come to the second part. What is the EPS of Efficient Limited after acquisition of Healthy Limited. Now they are saying, let's say the acquisition has happened at whatever ratio you have decided, right? After that, what is the EPS, students? We can calculate that. Yes, very easily we can calculate that. So the second part, EPS after acquisition. So EPS can be calculated as by clubbing the earnings, right? 50 lakhs plus 150 lakhs that we have calculated above while we were organizing our data, divided by 28.75 lakhs. That is the total number of shares. So this becomes 6.956 per share. Okay. So the EPS after acquisition has become 6.956 per share. If we want to just see what was the EPS before acquisition, it was 5 rupees. So 5 rupees has moved up to 6.956 per share, which is a good sign, right? Now let's come to the next part. What is the expected market price per share and the market cap of Efficient Limited after acquisition, assuming P ratio of the firm Efficient Limited remains unchanged? So they are saying, so the again a step-by-step, question. So in the previous part, if let's say in the first part, they've asked us to calculate the swap ratio, we have calculated that. In the next part, the swap ratio is used to calculate the total number of shares and hence EPS. Now in the second part, that EPS will be used to calculate the market price per share using the same PE ratio and hence the market capitalization. Okay. So third part, MPS is equal to PE ratio multiplied by EPS. Correct, students? What is the PE ratio of Efficient Limited before merger? Because it is said that it will remain same. It is 10. It is 10. So 10 into 6.956. Okay. So this becomes 69.56 per share. And hence the market capitalization will become the total number of shares, which is 28.75, students. Lakhs multiplied by 69.56, right? So this becomes 69.56 into 28.75 lakhs. So 1,999.85. So the overall market capitalization is equal to 1,999.85 lakhs. Okay. Now the last part of the question, calculate the free float market cap of the merged firm. Now students, if you remember in one of the formula I mentioned, what do we mean by the free float market cap? Free float market cap is equal to 1 minus promoters holding, right? Because whatever promoters are holding, that is not a free float. Okay, that is not a free float. So free float is equal to 1 minus promoters holding, right? So what was our combined promoters holding value, or let's say percentage? It was how much in the first part, B sub part, we have calculated that 60%, right? So let's take the 60%, and hence the free float percentage will be 1 minus 60% is equal to 40%. Now using this free float percentage, we will calculate the free float market capitalization. This will become how much? 40% multiplied by 1,999.85 lakhs. So hence free float market cap is equal to rupees 799.94 lakhs. Easy and simple, students. This question was a very step-by-step question, because in the first part, B sub part, we have already calculated the promoters holding, and using that we have to calculate the free float cap, right? Free float market cap, which is also easier. In the third part, the question as itself asked us to calculate the overall market cap, right? Basis the same PE ratio. So very simple and logical question, students. I hope this is clear. Okay. Okay, students. Now let us move to the next part. Question number 19. So this is a very, very, very good question, students, and it is one of its kind, because this is on the demerger, right? Till now we have all discussed about the mergers or acquisitions, right? This is about the demerger. Let's go through the question very carefully, and accordingly we will solve for the question. Yes. Yes, students, please, I request all of you to please concentrate here. Okay. The following information is related to Fortune India Limited having two divisions, Pharma division and fast moving consumer goods division. So please try to remember certain names here, okay, so that it gets registered. So there is a name of the company called Fortune India Limited. It has two divisions, Pharma and FMCG. Paid up share capital of Fortune India Limited is consisting of 3,000 lakhs equity shares of rupees 1 each. Fortune India Limited decided to demerge Pharma division as Fortune Pharma Limited with effect from 1st of April 2009. The details of Fortune India Limited just before the merger, just before the demerger, because the demerger happened on 1st of April 2009. We are talking about 31st of March 2009. So just before the demerger, the details and of Fortune Pharma Limited just after the merger is given as follows. So this is the before merger and this is after merger. But after merger also only for pharma, not for FMCG. And this is before merger for both, right? So there are outside liabilities in the form of loans, unsecured loans, right? Current liabilities and provisions. Then there are fixed assets, investments, current assets, loans and advances, and deferred tax or miscellaneous expenses. Okay. Understood, students? Board of directors of the company have decided to issue necessary equity shares of Fortune Pharma Limited of rupees 1 each without any consideration to the shareholders of Fortune India Limited. So Fortune Pharma is a new company that has been formed, and Fortune India is the old company, right? Now understand, students, this from the perspective of, let's say there is a, so there is this company called Fortune India Limited, and it has two divisions, as it is said. Okay, I'm dividing it to show two divisions. One is FMCG and second is pharma, right? Now what they are doing is, this was till 31st March 09 that there existed a company called Fortune India. Now just on 1st of April, right? 1st April 09, two companies came into existence. One is Fortune India and second is Fortune Pharma. So Fortune India retained the business of FMCG and Fortune Pharma got the business of pharmaceuticals. Okay. Case is clear. So this pharma is incorporated into a new company. Now, the moment this happens, so let's say on 31st of March 2009, the value of Fortune India Limited's share price was, let's say, 100. I'm just taking an example. Okay. Now, the moment on 1st of April 2009, the new company is formed, right? So, don't you think that the existing company's shares value will go down because some of the assets are transferred to the new company, some of the revenue generating activity is transferred to the new company, right? So what will happen here? So let's say this is Fortune India. Okay. So just after the demerger, 100 became 70. Now, shareholders of Fortune India will say that we will need some compensation, right? Because the moment you have transferred certain assets, right, we have suffered a loss in the valuation. So to cover up that, 30 rupees worth of shares will be issued from Fortune Pharma to the shareholders back again. So that now the 100 worth of shares with a investor before this demerger is now splitted into 70 rupees as investment in Fortune India, which is continuing with FMCG business, and 30 rupees in Fortune Pharma, which is the pharma business. And in totality, again, after the demerger, it is restored back to 100. Okay, students. This is what it is mentioned here. Okay. But they have not given us that how many shares will be issued. They have said that necessary issue of equity shares will happen. For that purpose, following points are to be considered. What are they? Transfer of liabilities and assets at book value. Okay, whatever is the assets and liabilities getting transferred, they will be transferred at book value. That means from Fortune India to Fortune Pharma. Okay. Estimated profit for the year, for the next year is 11,400 for Fortune India Limited and 1470 for Fortune Pharma Limited. Okay. Fine. Estimated market price of Fortune Pharma is 24.50 per share. That is for the new company, right? So this is for the FMCG business and this is for the pharma business. Okay, this is also clear. Average P ratio of FMCG sector is 42 and pharma sector is 25, which is to be expected for both the companies. Okay, now the ratio in which shares of Fortune Pharma are to be issued to the shareholders of Fortune India Limited, they are asking us to calculate that ratio. Now let's start, students. Okay, so first of all, Fortune India. Students, if you see Fortune India have a shares base of 3000 lakhs, right? Perfect. Now, number of shares that will be issued from the Fortune Pharma to the old shareholders will actually depend on something called as EPS, right? Or let's say what is the profitability that we are going to earn from there. Because if you see again, the fact pattern of the question is more on the earnings side. We have been given for the next year what are going to be our earnings, what is the price, right? So can we use that information? So let's say market price is 24.50 that is given to us. The PE ratio is also given to us, which is how much? 25. So if PE ratio and MPS is given, can we calculate the EPS? Yes. Earnings per share can be calculated. 24.50 divided by 25. So which is 0.98 per share. Now students, one more information to be noted is we have been given profits for Fortune Pharma, right? Those are given as 1470 for the next year. So if EPS is 0.98 and the total profits are 1470 lakhs, can we calculate the number of shares? Yes, we can calculate because total profits divided by EPS is equal to the number of shares. So students, please note, we have back calculated the number of shares divided by 0.98. Sorry. Sorry. So this becomes 1500 lakhs. Simple. Any questions till now, students? So we have used this information to back calculate the number of shares. So the ratio will become like this: 1500 lakhs divided by 3000 lakhs. So just before demerger, 3000 lakhs were the number of shares of Fortune India Limited. And we have calculated that basis the profits, basis the market price and P ratio that is given to us, the number of shares for Fortune Pharma Limited should be 1500 lakhs, and hence 1500 divided by 3000. So this becomes 0.5 for one share. Okay, so the ratio is, hence the ratio is 0.5 share of Fortune Pharma for one share of Fortune India, right? This is understood. Now let's come to the second part, expected market price of Fortune India. So they are also asking us to calculate once this demerger happens, then what is going to be the expected market price? So can anyone tell me how can we arrive at, students? It's very easy. Just try. All this information is given. We have to calculate the expected market price of the new company from a forward-looking data. What is the, sorry, not the new company, the existing company, which is the Fortune India Limited. Now, for Fortune India Limited, the FMCG one, what information should we use or what calculation should we do to arrive at the expected market price, students? Tell me, what information we can use to calculate the expected market price? Can anyone share their thoughts? How we will calculate the expected market price, students? Or at least let's say what approach we can use to calculate it. And this is after demerger. What business is left with Fortune India Limited, which is for the FMCG business? Very good, Shruti. Shruti, you're right. Anyone else want to attempt? How can we calculate the expected market price, students? Come on, tell me. Has it to do something with the balance sheet? No. Has it to do something with the forward-looking data on what? On EPS and PE ratio, students. Yes, Shruti. Shruti has given the right answer. So, expected market price of Fortune India, which is a which is a FMCG company, sorry. FMCG will be calculated how? Estimated profits comes out to how much? It is given in the question 11,400 lakhs, right? So this is actually 11,400. Then number of shares, students, to calculate EPS. Okay. Tell me, I'm giving two options. Tell me which option is right. Option one or option two. Option one is 3,000 plus 1,500 shares. That is in totality, I should take 4,500 shares. Or option two is I should only take 3,000 shares. Tell me, students, what should I take? Come on. Option one, for calculating the EPS, right? This will give me EPS. I have the total profits. I have to take the number of shares for Fortune India Limited. This is the FMCG company. Now, at least answer this question, students. What should I take? Whether I should take option one, which is the total shares, the existing share of 3,000 plus the new shares that are issued of Fortune Pharma Limited to the shareholders. Or should I take option two, which is the Fortune India Limited's shares? Yes, students. What do you think? Should we take the total shares or 3,000? Okay, Shruti, you're right. Very good. Anyone else have some other viewpoint? Or let's say what to be taken, option one or option two? Come on, students. Yes. So, yes, let me, I think, proceed. So, Shruti, you're right. 3000 is the correct answer. The reason being, 1500 are the shares issued from Fortune Pharma. Those are not belonging to Fortune India, right? We are talking about the EPS of Fortune India. So for that, we will take this 3000 shares. So I'm just deleting this. There is nothing called option 1 or option 2 in the solution. Okay. So this becomes 11,400 divided by 3000, 3.8. And hence the estimated PE ratio is how much? 42, right? For FMCG. So 42 into 3.8 is the MPS. Market price per share is 3.8 into 42, right? So this is actually 159.60. Then third part, students. Book value per share of both the companies immediately after demerger. Now we have to calculate the book value immediately after demerger. So for that, let's plot whatever is given in the question before demerger, after demerger, and again after demerger. So this before demerger, we are talking about Fortune India, which is the total balance sheet that is given to us, right? From that, we will arrive at the book value. Then Fortune Pharma, after demerger, that is also given to us. And Fortune India before demerger minus Fortune Pharma after demerger, we will get after demerger of Fortune India, which is the FMCG business. Okay. So the assets total is how much? Assets total is 20,400. All these things needs to be added, right? 12,300 plus 3,200 plus 73 minus 200. So this comes as total comes out to be 70,000 lakhs. Similarly, for Fortune Pharma, the total assets stands at 25,100 lakhs. Then Fortune India, the balance part will be 70,000 minus 25,100 because it's a book value transfer, right? So the balance is 44,900 lakhs. Liabilities. The total liabilities is 25,000 lakhs. Okay. Then 4,100 lakhs is the liability here of Fortune Pharma. The balance comes out to be 20,900 lakhs. Correct? If we calculate the net amount, it will be 70,000 minus 25,000, which is 45,000 lakhs net book value. Okay. 21,000 lakhs, then 24,000 lakhs. Students, any questions, please do let me know. Otherwise, we are on the verge of completing this question. Number of equity shares. Before demerger were 3,000. After demerger in Fortune Pharma, it was 1,500, right? And this is all lakhs. and Fortune India, FMCG, still also had 3,000 lakhs as the remain. So book value per share. You want to calculate that? It comes out to be how much? Okay. So it comes out to how much? The amounts we have to just divide. 45,000 divided by 3,000 is 15. Then 21,000 divided by 1,500 is actually 14. And 24,000 divided by 3,000 is actually 8. So let us go back to the question and see whether we have given the answer. Yes, book value per share of both the companies immediately after demerger. So book value immediately after demerger is 14 and 8. Okay, Shruti? Okay, students. So I think this was the last question. The next question, along with some of the theoretical parts and startup finance, we will cover in our next session, which would probably be the last session towards the closure. So I request CA Ashish sir, who is there with us, to help with the concluding remarks. Thank you, sir.
Deva, am I audible?
Yes, sir, you're audible.
Good. Thanks a lot for your session. I think only one question has been left. And how many questions has been left?
So, sir, one question is left, which is on this bank side.
Okay. So this will you cover in the next class.
Next class, along with startup finance and some of the theoretical part on merger and acquisition.
Okay, students. I think I have watching the queries. Students are saying, sir, concepts are very clear. So, student, the topic of merger and acquisition, we can say it is one of the very important topic from advanced financial management perspective, because even if we start reading any financial newspaper, there are always some merger and acquisition talks are going on. Recently, there was a, if you are aware that there are some failure of the merger of G Cinema, GTV, I think G Cinema or GTV and the Sony Entertainment. So their merger as an acquisition process has been going for the 1 year, but 1.5 year, but ultimately it has. Am I Devas right? It is.
Yes, sir. Absolutely, sir.
It has been failed now.
Yes, sir.
And there are recently or around 1 year back, there was a merger acquisitions of the HDFC Bank and HDFC Limited. So overall, we can see that this merger acquisition is a very important exercise, and it involves a lot of aspects. Okay, it involves our due diligence, law aspect, and our financial aspects. We are covering financial aspects because we have to see the arrangement should be beneficially for the both of the parties. Now, student, generally in this concept regard, I will like to discuss with you one of the concept that is called bootstrapping. Now, bootstrapping means, see, bootstrapping is related to the price earning ratio of the companies. Now, say there are two companies, one is A, another is B. Now, suppose A is acquiring B. Okay, so of course, when the company A is acquiring A, B, so the PE ratio of the A company will be prevail. So it may be sometime what happens due to it, or it may be possible that if the company A has a higher PE ratio, so of course the shareholders of the B Limited will get a benefit of the same. This concept is called bootstrapping. Now, recently, I think in a last examination, there was some confusion regarding PE ratio, because mistakenly in a paper's question, I think it was mentioned the PE ratio of the merged company will remain the same. So in this case, some student confusion has created among the mind of the student. But ICAI has taken care considering both aspects, because the question from it has been adapted from the study material. It has where it has been mentioned the PE ratio of the acquiring company will remain the same, but mistakenly it got typed the acquired company will remain the same. So we have considered both answers. So in that case, you not to worry about any this such kind of a things in the examination. Of course, it is always a normal thing. The PE ratio of the acquiring company will be become the prominent. Now, uh, if student you have any query relating to any of the same, you can write to us, or you can contact us. Devas sir, can you jot down the telephone number?
0120 30
3045
45
956.
56.
Okay, student. So you can contact us this number, and I thanks Devas sir to you for sparing your precious time
Thanks a
and
lot.
enlightening the student on this topic that is very important from the financial management perspective, in advanced financial management perspective. And student, we thank you all for patiently listening to this lecture and responding and making it more interactive by asking the questions. Because if you ask the question, then it means that you are interacting with us,
Right.
and we are also very happy to answer your each and every query. Okay,
Right.
student, thank you. Have a nice day. Have a nice day, Divas sir.
Thank you, sir. Thank you, sir. Have a nice day, sir.
You
Thank you.
too. You too. Okay.